In times of economic uncertainty, many investors turn to gold as a safe haven. But is this the right time to invest in gold? To address this question, we have to dwell deep into the factors that affect the price of the gold. Now, several factors impact the price of the gold, and understanding these factors will help you to make an informed decision. Now, the factors that contribute to gold price movements are economic uncertainty, inflation and currency devaluation, interest rates, supply and demand, and geopolitical events. Now, the first and foremost important factor is the economic uncertainty. So, how do we measure the economic uncertainty? There are various platforms that measure the economic uncertainty. I have picked on this specific website called Economic Policy Uncertainty. Their methodology is briefly stated here. So they pick up three components to measure the economic uncertainty based on research. It is the research directors are from some of the top business schools like Kellogg, Stanford, and Chicago. Coming back to the chart, so as you can see, this chart is starts from 1997 and up till August 2024. Right now, in September 2021, when the attacks on the World Trade Center took place, the economic uncertainty peaked at to 166.14. However, subsequently in 2008, during the economic crisis, it again peaked, and since that time, it has constantly been on the rise, while peaking up during the COVID time in May 2020. Since the COVID pandemic has passed, the economic uncertainty slightly decreased, but has been on the higher end. And as of today, it stands at 246. So if I compare the current trend of 246 versus the peak at the time of September 2001, it was 167. So it has nearly doubled. We have seen the global uncertainty index. Let's see how it correlates with the prices of the gold. As you can see in this chart, the gold prices have been constantly on the rise as the economic uncertainty increased. Post 2008 world economic crisis, the gold price has been constantly on the rise. As you saw on the previous chart, the uncertainty also kept rising post 2008, and the same is very much visible in the price of the gold. It peaked at in 2012, and post that it slightly came down, but after that it has again started going up, specifically at the time of the global pandemic of COVID. Even post COVID era, the gold prices are not stopping. There are multiple other factors to it which we will be explaining next. But we in this chart we can closely see the correlation between the uncertainty and the price of the gold. Now the second factor is the inflation and currency devaluation. Gold is often seen as a hedge against inflation and currency devaluation. As the purchasing power of fiat currencies decreases, the price of gold tends to rise. Central bank policies such as quantitative easing can lead to concerns about inflation and currency devaluation, potentially boosting gold prices. Gold is renowned for its role as a hedge against economic uncertainty and inflation, and gold has long captivated investors. One key factor influencing gold prices is the relationship between real yields and inflation. Over the long term, gold has protected one against the pernicious effect of inflation and remains a powerful diversifier within an investment portfolio. Now, the third factor is interest rates. There is typically an inverse relationship between interest rates and gold prices. When interest rates are low, the opportunity cost of holding non yielding assets like gold decreases, making it more attractive to investors. Conversely, when interest rates rise, other investments may become more appealing, potentially putting downward pressure on the gold prices. In this chart, you can clearly see the inverse relationship between the US real interest rates and the gold prices for the last 20 years. Like any commodity, gold prices are influenced by supply and demand dynamics. Factors affecting supply include mining production trends and central bank sales. Demand is driven by various sectors including jewelry industry, industrial applications, and investment demand, that is gold ETFs, physical gold purchases. Now looking at the countries with the most gold reserves in 2024, US stands at number 1 position. However, the other countries are also catching up, and that is what is resulting in the increased demand. Russia, China, Turkey added approximately 2,500 tons of gold in the last 10 years alone. The huge demand for gold from these countries to build their gold reserves resulted in increasing the overall gold prices across the globe. Now imagine gold as a roller coaster, rising and falling with each twist and turn of global politics. Let's take a quick ride through history. In 1970s, the oil crisis hits and gold shoots up from $65 to $183 an ounce. That's a 183% climb in just 2 years. Going forward to 1980s, Cold War tensions boiled over with the Soviet invasion of Afghanistan, and gold price it nearly doubles, peaking at $850 an ounce. Fast forward to 2001, the 9/11 attacks shake the world, and the gold rises by 6% when market reopens, starting a long bull run. Further in going ahead to 2008, the global financial crisis strikes. After an initial drop, gold soars from 720 to 1895 by 2011. That's a 163% jump. And to the recent 2020, the COVID pandemic spreads and gold hits an all-time high of $2,067, up 36% in just 8 months. But here's the plot twist. While gold often shines in dark times, it's not a guaranteed safe haven. The gold market is complex, influenced by factors like interest rates and currency movements. So, what's the lesson? Gold has often been a beacon in geopolitical storms, but past performance does not guarantee future results. It's a
Ultimately,
thrilling ride,
the
but
question,
remember
should you
to
buy gold
fasten your
now,
seatbelt
doesn't
and
have a
consider
one
your
size fit
destination
all
before you
answer.
hop on.
By understanding the factors that influence the gold price and understanding your personal investment choices, you can make a more informed decision that aligns with your investment objectives and help you secure your portfolio in a much more meaningful manner. If you found this video interesting, please like and subscribe to watch more such videos.